There is a question that sits quietly in the back of the mind of almost every person who has ever heard about the stock market but never truly committed to understanding it. And that question is simply this: does it actually work? Not in theory, not in textbooks, not in the carefully constructed arguments of financial advisors trying to sell a product, but in real life, across real decades, for real ordinary people who had no special advantages, no inherited fortune, and no insider knowledge. That is the question this video is going to answer. Not with opinion, not with projections, but with documented historical evidence that anyone watching this can independently verify. The story of the stock market and generational wealth does not begin in a boardroom or a Wall Street trading floor. It begins with a simple and powerful mathematical reality that has repeated itself consistently across more than a century of recorded financial history. According to data published by the Federal Reserve Bank of St. Louis and independently verified by researchers at the London Business School in their Global Investment Returns Yearbook, the United States stock market has delivered an average annual real return, meaning after accounting for inflation, of approximately 6.5% per year since 1900. That is not a cherry-picked number from a good decade. That is the average across world wars, economic depressions, financial crises, pandemics, and periods of extreme political uncertainty. More than 120 years of documented market history that anyone can access and verify through the Federal Reserve's publicly available economic database at fred.stlouisfed.org. To understand what that number actually means in human terms, consider this documented example. According to research published by Vanguard, one of the world's largest and most respected investment management companies, an investor who placed $10,000 into a broad United States stock market index fund in January 1980 and never touched it, never tried to time the market, never panicked during downturns, and simply allowed it to grow, would have seen that investment grow to approximately $760,000 by the end of 2023. That is not a promise of future results. It is a documented historical outcome based on the actual performance of the market over that specific period, and it represents the kind of quiet generational wealth that is built not through speculation but through patience and time. The historical record also shows us something deeply important about what happens during the periods when the market falls. Between 1929 and 1932, the United States stock market lost approximately 89% of its value during the Great Depression, the single worst market collapse in recorded American financial history, according to data from the National Bureau of Economic Research. And yet, by 1954, the market had not only fully recovered, but had surpassed its previous highs. Similarly, when the market collapsed during the 2008 global financial crisis, losing approximately 50% of its value between October 2007 and March 2009, according to S&P 500 historical data, it had fully recovered those losses by 2013 and went on to reach record highs in the years that followed. The pattern that emerges from studying these historical periods is not that the market always goes up in the short term. It clearly does not. But that over sufficiently long periods of time, the market has consistently recovered and grown beyond every previous decline it has experienced. What makes this history so significant for ordinary people is not the large numbers. It is the accessibility of the mechanism that produced them. The investors who benefited from these historical returns were not exclusively wealthy. According to research from the National Bureau of Economic Research and Data compiled by economists Emmanuel Saiz and Gabriel Zuckman at the University of California, Berkeley, the democratization of stock market access through index funds, pioneered by John Bogle, who founded Vanguard in 1974, made it possible for ordinary wage earners to participate in the same market returns that were previously available only to institutional investors and the very wealthy. John Bogle's own documented philosophy, preserved in his 1999 book Common Sense on Mutual Funds, was that ordinary people did not need to beat the market, they simply needed to own it consistently and patiently over time. The evidence that the stock market builds generational wealth is not theoretical. It is documented, it is publicly available, and it has been consistent across more than a century of economic history that includes some of the most turbulent periods the modern world has ever seen. The families that benefited most from this history were not necessarily the richest or the most financially sophisticated. They were the ones who understood the system early enough, stayed patient long enough, and trusted the documented evidence of what time and consistent participation in market growth can produce for anyone willing to begin.